Hello, my name is David Matkin. I've produced this video to help students of public administration and public affairs better understand the concept of liabilities as it is understood from an accrual basis of accounting. If you haven't already watched my videos on financial position and assets, I recommend you pause this video and start with those. What are liabilities? Well, generally speaking, liabilities are claims on an entity's economic resources. The claims must be objectively measured monetary values that are legally enforceable. This definition suggests a three-part test. Is there a legal claim on the entity's economic resources? Second, does the claim have an objectively determined monetary value? And third, are the terms of the arrangement satisfied so that the obligation must be paid? Let me just take each one of these three. First, is there a legal claim? The legal claim or obligation is really the essence of a liability. Claims are created when one party provides a service or a resource to another party and has a credible legal expectation that they can recover the economic value of those resources or services. Second, monetary value is objectively determined. The claim must be measured as a monetary value in order to be recorded as a liability. This may seem obvious, but organizations can have a lot of different types of obligations, such as moral obligations, memoranda of understanding, formal and informal promises, and professional duties. There may be any number of real obligations, but if those obligations don't have an objective monetary value, they will not be liabilities and will not affect an entity's financial position. Third, the claim must be paid. The key concept here is that there are service arrangements such as contracts, service agreements, purchase orders that do not represent claims that must be paid. Rather, those documents establish an agreement on the terms of a financial transaction. They likely lead to a liability once the terms are satisfied, but they are not in and of themselves a liability. If the answer to each one of these three parts is yes, then the entity should be recording a liability and the financial position is going to be affected. What are the most common types of liabilities? Well, just like when we talked about assets, we use the term accounts to categorize liabilities. The level of specificity of those accounts is determined by opinions on materiality. Liability accounts are often identified by the suffix payable. Accounts payable are bills that an entity must pay in the near future. Wages payable are obligations associated with salary and compensation. Grants payable represent the value of grants that have been awarded by an entity but they haven't paid yet. Donations payable are promises to make a donation. Unearned income is the value of an asset that an entity has received but they have not yet earned. For example, a counseling center may receive an advance payment for counseling that they will be providing in the future. That advance payment is a resource. They have the assets, but those assets haven't been earned yet. And until the counseling center earns the assets by providing the counseling services, the asset is going to be offset by a liability called unearned income. Notes payable are a kind of debt that needs to be paid in full over multiple years, usually a term of 2 to 10 years. A car loan, for example, is a note. Mortgages, pensions, bonds are long-term liabilities that are repaid over many years, even decades. The liability accounts on your screen are listed in order of how soon the obligation must be paid, or we may say the time to maturity. The accounts at the top are typically repaid in terms of months, and the accounts at the bottom are repaid in terms of decades. How does an entity increase or decrease its liabilities? Well, we should return here to the fundamental equation of accounting, which is at the top of the screen. Assets are equal to liabilities plus owner's equity. Any increase to liabilities or decreases to liabilities needs to have an offsetting entry that keeps that equation in balance. First, a liability account can increase with a decrease in another liability account. This happens when short-term liabilities are refinanced into long-term liabilities or vice versa. This is not a common transaction for most public organizations, but it does happen. When claims move from one liability account to another, the total value of the liabilities stays the same. Second, a liability account can move with changes in asset accounts. This is most common when entities borrow cash resources or finance the purchase of a non-cash resource, like financing a new fire truck or delivery van. Asset accounts can also help decrease liabilities. Remember, the liabilities are claims on resources. So, if an entity satisfies those claims and sends their resources to parties with claims on those resources, those claims are now made whole, and the liability is gone, along with the resource. Third, liabilities can also be affected by changes in owner's equity. When liabilities are forgiven by a party with a legal claim, this releases that liability claim on economic resources to the owner, and therefore increases the owner's equity. Remember, an increase to owner's equity is called a revenue. Liabilities can also increase with a decrease to owner's equity. This happens when an outside party performs a service for an entity, like performing consulting services, provides the entity with an invoice, and now has a legal claim on the entity's resources. Remember that the decrease in owner's equity is called an expense and recognizes that assets must be consumed. Okay, thank you for watching this video, and I hope it helps you understand liabilities.